Okay, welcome back, founders. We are here with Laurie Dmytryshyn. We're here for part 2 of this whole conversation about equity financing, equity capital. And in part 2, what we actually want to dig into here a little bit, it's all these nuances of equity that I think a lot of founders really haven't tapped into. And let's just kind of pick up where you left off in part 1, because there was many important things there, I think, that maybe we can explore a little bit. First of all, let's actually talk a little bit about EBITDA, EBIT, as some people refer to it, just so that founders who are listening are actually clear what that is and why we're looking to strengthen that, and why an equity partner, equity financier would want to see a strong EBIT there.
Okay, I'm not an accountant, so I'm going to tell you that right off the bat. So anything I say could be incorrect when it comes to accounting. Anyway, I know enough to be dangerous. But what we look at, and again, it sort of depends on the stage of the company, but EBITDA is earning before interest, taxes, depreciation, and amortization. So, you know, basically we want to see a company, again, if we're putting a larger check size in, you know, we definitely want to see fairly decent EBITDA, and we want to see that ability for that EBITDA to grow over the period of time that our investment is in there too as well. You know, often, again, it depends on the company. And we'll probably talk a little bit about valuation after. But, you know, a company with good, strong growth potential is something that we definitely, you know, are looking for. Because as we said, you know, we're putting our investment in, but we want to get a good rate of return on the back end. So, you know, sometimes that a company with good EBITDA, we're investing in there. What can happen is the company can make distributions or dividends back to investors and entrepreneurs too. So that's always a good home run. And it is a good way for us to get some of our investment back sort of in the earlier days too as well, before there's an exit event.
So just to, because I want to review this point with founders listening in, because Laurie, we've known each other for a while now, and for many years, I have personally been on a soapbox, you know, shouting out with my megaphone, like, please profit in business, right?
Yes, I agree.
Too many have been just barely breaking even, and, you know, proud of it. And yes, definitely break even for sure, you know, better than the alternatives. But usually those break evens do not include a fair market owner's salary, right? Like they approach business from this place of a small business owner starting up, and I'm supposed to bootstrap, and they're not accounting for all the true expenses. And then when we get an equity financier or an accountant or an evaluator that comes in to look at the financial health of the business, they see all these missed expenses, they add them, and then all of a sudden our net profit starts to diminish again. So EBITDA, sometimes I always look at it as this is net profit before the taxes, before the amortization, before the depreciation. So another huge incentive to actually strengthen that number, not at the cost of people, not at the cost of planet, not at the cost of purpose, but to have a healthy business. So now, once we have that healthy business, now we're able to attract potentially equity financiers. Can I say an equity partner? Would that make sense?
Yeah, or is that definitely, okay. Yeah, I would agree.
Okay. So now we've got that opportunity where they might be interested, but now we're also talking about growth, because they need to, this isn't just about here, get, you know, put your money in and watch us do really well, right, with our business.
Right.
But talk about growth a little bit. When you say growth, ideally, what does growth look like? How would you define growth for a business so a founder can wrap their head around that?
That's a great question. And again, like, I think it's almost on a case-by-case basis, right? I think it depends on what industry you're in. You know, we've seen, you know, talking about EBITDA, we've seen the tech industry where they've got that ability for you know, massive growth through sort of SaaS models too as well. So they've got super fast growth, right? Where we've seen some companies that are maybe doubling every year. You know, they have that ability to double every year. So that's really good growth. You know, but the companies that we tend to see Again, I would even say in the first couple years, I would say, probably 25 to 50% is really good growth too as well. But again, it just sort of depends on where that company's at in their life cycle.
Are you referring to top line growth, or are you referring?
Sorry, I was referring to top line growth.
Top line growth.
And again, the challenge with bottom line growth in early stage companies is that often it takes a couple of years to actually get that positive EBITDA. But we, in our portfolio right now, actually, it is the best investment we've made from a return basis is a company that just consistently increases their EBITDA. Right? They're just in this industry that, appears to be recession proof. And we've got at least 2 times, well, we've got more than 2 times, we're probably on 3 times our investment back over the past, kind of 8 years, just through distributions from this company too, right? So I think you always want to try and create that profitable business, but I, like you, hear the same thing. It's harder in tech because a lot of that sort of growth goes back into R&D. Too as well. So, it's harder from a bottom line basis, but, at the end of the day, building a profitable business, I mean, that to me, that's the goal, no matter what business you're in.
Ideally, hopefully for every founder listening there, right? This isn't a job that you're building for yourself. It is ideally a business that's healthy.
Yeah.
So when I think about what you're saying there with respect to growth, we've got the top line sales that are coming in. We've got that net profit that continues to remain healthy. You actually mentioned something about earning, I think you said 8 times the investment that you initially put in through distributions. Distributions are also—
I think it was 3 times.
3 times, sorry.
Times.
Okay.
Yeah, that's okay.
8 would be
if it
great.
was 8, hopefully in another 8 years, it'll be 8. That'd be fantastic.
Yeah, wouldn't that be lovely? And some do pay off, right? And they pay off quite quickly. But when you say distributions, you're referring to dividends, right? Where these could be paid quarterly or annually, whatever that looks like.
Yeah.
And so in addition to that dividend, then your equity is still being held in that company.
Yeah.
You're still holding on to the same amount of shares.
Yeah.
And so then my big question, how do you get an equity partner out? How do they exit from the business? So if we were going to take, for example, you come in at a business that's worth $500,000. Let's just say you put $100,000 of equity into the business, right? That if the business is worth $500,000 and you're putting in $100,000, to me that sounds like you've got at least 20% ownership of the business.
Yep.
And so now the question becomes, let's say you're in there for 5-10 years. Maybe that's another question. How long do you typically stay in? Let's say it's 10 years. And now how do you get out? Let's do the eye opener for founders on this one.
Okay. Sounds good. Okay. And there's many different ways that we can get out, but usually, as I said, we like to have that conversation in the beginning. So what we will do, normally entrepreneurs will look at, there's a couple different ways to get out. Number one is the entrepreneur can buy back our shares at a premium, right? So we end up getting, our rate of return on them. So that's one option. Number 2 is an acquisition. So someone else buys the business, and normally that's like for the entrepreneurs that we see right now that are really looking for, kind of big, high growth. Normally acquisition is usually the number 1 exit strategy that they've got, that you hope that someone's going to come in and buy the business. The third, IPO, in the past, public offering is something that, we didn't really see a lot of Canadian companies going that route, but it's been interesting because just in the last couple months, we're seeing a little bit more of it too. And companies, in healthcare, healthcare is a hot sector right now too. So we are seeing some more public offerings in the Canadian landscape. Normally in the US, that's an option. A lot of the, tech companies and other companies will go, but so that's basically, there's kind of, 3 ways to get out.
So when you talk about that first way where the equity investor gets their money out at a premium with a lift, is that negotiated in those early days too, what that lift would be, or is it based on the performance of the company?
It can go either way. What we tend to do is we do like to negotiate that off the beginning, like at the beginning. And so what we'll do is when we negotiate sort of a term sheet with our entrepreneurs, we'll often put a clause in there that we'll want to go into the shareholders agreement where, you know, we've got that at the, you know, at 8 years time, like in 8 years time from when we invested, that, you know, maybe the entrepreneur has the ability to buy the company back at we usually like, Greg likes to put a formula in there too. So the formula might be 8 times EBITDA, right, at this certain point in time. So there's a lot of different ways you can do it. You know, the investors can also put their shares. So basically say, okay, at 8 years time, entrepreneur, you're going to buy back, the company's going to buy back our shares at this price if we so choose. So there's just so many ways you can do it, or it just happens organically, right? The entrepreneur approaches the investor and says, okay, you know, I've been at this for 8 years. Do you want to sell your shares? So, you know, there's, again, it gets kind of complicated. But a lot of this is covered in the shareholders agreement that's negotiated between the investors and the entrepreneur. So that's almost a guideline for how, you know, how the process goes. And again, it's case by case depending on the entrepreneur and the investor.
So I'm hearing lots of flexibility, unlike debt, where
lots of flexibility.
This is the term, this is when you repay.
Yeah.
If it doesn't happen, it's going on your credit bureau, we're coming after you, right? We're calling the loan. That we're typically not going to see from an equity partner. There's a lot of, it's a partnership, right? Because you're both in it to win it, right? Like really at the end of the day. But what I'm hearing here is that the equity partner, and they might be called an angel, but they're still looking, this is an investment. It is still about making money.
We would like to get a return.
And every founder, really, your business should be an investment too, right? Like they should be looking at their business as an investment, not as, you know, something that they're super passionate about and want to make the world a better place because of it. Yes, but you still need to be making that money. Just a question on due diligence, because I think this hits a lot of entrepreneurs too, out of surprise, going, what is this whole process? I wasn't expecting this. I thought you'd put money in the business and everything would be, you know, hunky-dory and easy. But tell us a little bit about what due diligence is and what that process might look like, what a founder should be aware of there. Okay,
so, you know, and with respect to due diligence, we see a lot of different investors take different approaches. Some do extensive due diligence and some do little due diligence because maybe they know the entrepreneur and they just want to support them. But basically, due diligence is the process by which the investors want to learn everything we possibly can about the investment opportunity and the entrepreneur. When we invest number one in people. So we're looking for entrepreneurs that are coachable, that are persistent, that, you know, are growth oriented, that will work well with others. You know, those are things that we want to see. And so what we're going to do with respect to a due diligence process, and again, I'm just talking about ourselves, is that we're going to try and get to know that entrepreneur. So it is a little bit harder with us to, you know, if you cold call us, we don't have any connections. It's going to be a harder go than it would be if we know someone that knows you and your business, or we know you and your business, if we have some expertise. But the one thing I always say to entrepreneurs is due diligence will take probably at least 2 or 3 times the amount of time that you think it's going to take. So we always recommend people, like, at a minimum, start your due diligence 6 months before you need that investment, right? Because there's nothing worse than, you know, someone knocking on your door and saying, look, I need money, I've got this bill due, you know, and we're like, well, we can't help you. You know, it doesn't matter how good your business is. Like, if you need the money tomorrow, you know, that's we're not the right people for you to be talking to. We're really looking for a partnership too. We want to do everything we can to help your company grow, and we're very active and hands-on. So literally with due diligence, you got to start minimum of 6 months. I'd even say a year before, just to make sure. You really want to tell your story. It's critical that you research the potential investors you're going after, and that you tell a story so that they understand what the problem and the opportunity is. I think that's critical. So what often happens with us is the entrepreneur will start with a pitch deck. So they'll put together a pitch deck that, talks about the opportunity, the problem they're solving, talks about themselves and their experience and how they're going to help solve this problem, talks a little bit about the market. Like, really, honestly, it's kind of a mini business plan in a way. Like, it, gives a little bit on financials. What you're trying to do is just to get that entrepreneur interested. And then the next process, sort of after you kind of send your pitch deck out, is to do a call with the investor. And usually then you run through the pitch deck, the investor asks questions, and then the investor decides whether or not they want to go further into due diligence. If the investor does want to go further into due diligence, what we normally like to see is like a Dropbox or a OneHub or whatever, but just a list of all of your sort of essential business documentation. So we want to see corporate structure. We want to see your bylaws, your incorporation certificate. We want to see pretty much everything. Same thing in terms of the people. We want to see your team. We want to make sure that, you've got a good team in place with, financial expertise, marketing expertise, sales expertise, operations expertise. So it's kind of critical. We want to see it all in that regard. We want to see your operations plan. We want to see your growth strategy. We want to see, as I said, financials. We'll ask for probably 3 years past financials, and then probably 3 to 5 years projected too as well. So it's a lot of detail, and that's why we say, like, it's really important that you're prepared before you knock on the investor's door, and that you make sure you really understand who that investor is, and you're not wasting your time too as well, right? By making sure that that investor actually invests in your industry too, because sometimes that can happen too, right? So you're interviewing the investor as much as the investor is interviewing you.
Oh, okay. I love that. And I want to come back to that in a moment, because I've received contradictory advice on that piece. So I'm curious about that. But before we move on, what I love about what you've just said is, at the beginning of this conversation, it sounded like you were talking about many of the soft skills, right? How is this person to work with, and are they coachable? And
definitely.
And that sounds, yes, it's important. It sounds quite easy. But now the list that you just ran through, this is like behind the curtain, under the hood, under the
exactly
everything, right? You pull out all the dirt and all the good stuff too. I shouldn't just say dirt, but you're not hiding. The founder can't hide anything.
No, and there's nothing where we want honesty, right? Like, if you've had some situation, please let us know, because we don't want to find that out for someone else.
So important. But what a great exercise for any founder to do, regardless. Right? We should all know this. This should all be stuff that's ready at the quick, for us to know in terms of how to manage our business. So just so valuable. One question before I go back into the interviewing piece. A non-disclosure agreement. I've heard different things on an NDA as well. And I know a lot of founders out there, I don't want to share my information. They have access to everything. What is your take on a non-disclosure agreement, an NDA? Where do you sit with that?
It depends. Like, honestly, it depends on the company. A lot of people, as you said, have different, like, some don't. Some investors just say, look, I'm not signing an NDA, right, at all. Just because, our business is looking at a whole bunch of different companies. And so, like, we've got a liability if something happens, inadvertently, and, you just never know, right? So there's that risk, especially when you're doing this all day long for years and years and years. Mm-hmm. But that having been said, what we do always say is, look, we respect confidentiality. We wouldn't be in business if we didn't. No one's going to want to take our money, for out there blabbing about what's going on. So, again, with respect to that. But honestly, if I was an entrepreneur, I would get an NDA signed. Like I definitely, from the entrepreneur's side, if nothing else, it kind of alerts everyone to the, idea that, look, you got to be careful, right? Like this is important. This is someone's business. You have to be careful. Now, that being said, we do see so many different templates, with respect to NDAs. And so we've kind of gotten to the point where instead of going back and forth and having lawyers argue, we'll just use our template. We'll just say, hey, are you open to using our template? And then usually, for us, time, like we're not going to go likely beyond 2 years, unless it's some massive, company type thing and we have no choice. But if we are signing it, yeah, we're fairly careful on what we're signing because there's some bad ones out there, definitely.
Okay. And so talking about signing in contracts, when we look at NDAs and even potentially term sheets, if it gets as far as actually putting together that term sheet, the financial expense of that, where does that typically sit? Does that sit with an angel investor to pull all of that together? Is that the financial obligation of a founder to pull all of that together and the legal fees attached to it?
Okay, so again, it depends,
okay.
right? So NDAs, I would say probably the entrepreneur, like if they want to use their own NDA, then yeah, the investor's not going to pay for your NDA. So kind of keep that in the back of your mind that you have to have sort of that budget for legal expenses. With respect to term sheets, again, we've done different things on term sheets. So we've got some where both sides each pay their own individual expenses. And then, many of ours, what we'll do is we'll put a maximum amount where the company has to pay our legal expenses up to a certain dollar value too. So we've done that, especially with the earlier stage, we tend to at least put a dollar value in there just because they are very risky, right? So that is something that we've done. But again, it depends on like it's a negotiation, right? So it just depends on what kind of bargaining power you have.
So it sounds like having that conversation up front, right? A founder just having the conversation with the angel or the equity partner to say, what are your expectations in this space so that it can be budgeted? And then I would imagine too, we would see it in a cash flow somewhere, right?
Yeah.
As one of
Absolutely.
the expenses that they're going to be budgeting for.
Yeah.
Okay.
Absolutely.
So here's the question I have for equity partners and due diligence. And as a founder, as you mentioned in part one, there's so much more than just money at stake here.
Mm-hmm.
There's a relationship, there's networks, there's expertise, there's mentorship, there's coaching, right? This is really somebody that it's beyond the money, which is one of the huge advantages to equity. So what, and I don't want to use the word responsibility because I've heard from some angels where they're like, I don't want any questions asked of me. They really have no rights. I'm giving them money. There's no expectation.
Yeah.
What's your take on that? Should a founder really be doing their own due diligence on these equity partners in terms of, like you said, what industry do they explore?
Yeah.
Where have they invested in the past? What does it look like in the past? What's happened with the business? But what's your take? Because you don't want to insult an equity partner either in those early discussions. It seems like a sensitive kind of topic.
Yeah, if I was an entrepreneur, I would definitely want to get the right investor at the table because I think, if you have someone that has the expertise, that has the connections, that's going to support you in the ups and the downs. And, there's in business, there's as many downs as there are ups type thing too. So, yeah, like it's kind of like, it's like almost like a marriage in a way, right? Because you're going to be spending so much time with these people. But again, it does depend on, like you said, some investors just sprinkle, right? They're just going to sprinkle a little bit of money. It's almost like, betting just to see whether or not that company is going to hit the jackpot. So it really depends kind of on what you're looking for. But if you are looking for an investor that you want sort of that mentorship and that coaching, then I think absolutely it's critical that you get the right one. And you're going to be saving yourself a lot of time because you've got to be prepared. Like when you're raising money, there's going to be a lot of people saying no, right? So, it's kind of like the more time you spend up front trying to, research out, what industries does this investor invest in? What is their check size? The other question that I would always ask if I was an entrepreneur would be, do you do follow-on rounds? I think that's a critical thing too as well, because often what'll happen is, you know, an entrepreneur may not hit their projections. Like, I don't think I've ever seen anyone hit their projections. And so you're going to go through a time where you're cash strapped, right? And you're kind of reaching out to your investors to say, hey, you know, need some help here. You know, so in those types of conversations, you want to make sure that you've got investors that are writing that second check, you know, and it's not just one check that they're writing. So, you know, it depends, right? It kind of depends on what the entrepreneur's looking for.
But that's such a valuable point that you bring up, with having that discussion before, right? In terms of the follow-up rounds, as you mentioned, or that access to capital in the event that the milestones aren't met, unlike venture capital, which we won't go into right now because I don't think our audience is really in that space. It's a whole other episode, but that's really the space that angels play in, isn't it? Is really there to help that business owner, you know, build, grow the business, but seeing it as an investment at the same time, that win-win story.
Yeah.
Okay.
Definitely.
Well, I think, you know, I've kept you longer than anticipated for phase 2. Would you be open to just coming back for our part 3 to just talk about some of the pros and cons, and maybe potentially how equity might work with debt or not, if there's any challenges there? So we'll keep that one short because you've given us so much here, but thank you, Laurie, and founders. We'll see you back in here for part 3, where we'll get into the pros and cons of looking at equity financing. All right, see you in a bit.
Awesome. Thank you.